Yes, I know a lot of people are worried about all the AI hype.
Billion-dollar bets on artificial intelligence, AI, are reshaping entire markets, with startups valued more on future promise than actual earnings, a pattern that echoes every major financial crash from tulip mania to the dot-com collapse. Each cycle began with real innovation, but ended with belief outpacing reality and markets unraveling. Will AI be different, or are we watching the first signs of history repeating itself? Every financial bubble, no matter the era or technology, unfolds through four recurring mechanics. First, asset prices begin to rise faster than their underlying value. This is not just about numbers on a chart. It is about how stories and optimism start to shape markets. Nobel laureate Robert Shiller has shown that narratives, not just data, drive these surges. Second, belief becomes contagious. As the story spreads, confidence grows, and people follow the momentum. Daniel Kahneman describes how herd behavior takes over. People buy not because they have done the math, but because everyone else is buying. Third, the market self-reinforces. Each new buyer pushes prices higher, pulling in even more investors who fear missing out. Final, the system becomes fragile. When belief becomes the main fuel, the entire system grows unstable. If confidence wavers, prices can collapse with stunning speed. These mechanics form a checklist: rising prices outpacing value, belief overpowering evidence, the herd following the crowd, and a system left vulnerable to sudden shocks. This pattern does not depend on the technology or commodity involved. It depends on how people think, act, and convince each other that tomorrow will always be brighter than today. In February 1637, tulip bulbs in the Netherlands reached prices higher than most houses. Merchants like Adrian Paul borrowed heavily to buy bulbs, expecting fortunes overnight. When buyers defaulted at the Haarlem auctions, the market collapsed in days, leaving debts and unsold flowers behind. 2 centuries later, British investors poured money into railway companies, convinced every new line would pay off. By July 1846, Parliament rejected dozens of speculative projects, and railway shares crashed by 20% in a single morning. Many companies never laid a single track, but the railway itself endured, reshaping Britain. The dot-com era brought a new wave of optimism. In March 2000, Amazon stock fell nearly 90% as the Nasdaq tumbled, wiping out paper fortunes across Silicon Valley. Yet Amazon survived, showing that innovation can outlast a crash. In 2008, easy mortgages fueled a housing boom until repayments faltered. Defaults spread through securitized loans, triggering a global financial crisis. Each episode followed the same cycle. Belief outpaced reality. Fortunes rose and fell, but the underlying innovation, whether the tulip, the railway, or the internet, remained long after the bubble burst. Economist Carlota Perez describes this as the cycle that every technological revolution must pass through. AI is already at the heart of real-world business results. In fiscal year 2025, NVIDIA reported more than $110 billion in revenue, most of it tied to chips that power large language models and data center automation. Companies across healthcare, logistics, and energy now rely on AI platforms to streamline diagnostics, manage supply chains, and optimize energy consumption. In hospitals, automated image analysis speeds up cancer detection, while banks use language models to flag suspicious transactions in real time. Retailers deploy AI to predict inventory needs, reducing waste and improving margins. These applications are not just experiments. They deliver measurable efficiency and cost savings today. NVIDIA's story stands out. Once a graphics card maker, it has become the backbone supplier for the AI boom. CEO Jensen Huang has described the company's shift as an all-in gamble, with teams working through nights to meet demand from hyperscalers like Microsoft and Google. Unlike many firms valued on future promise, NVIDIA's profits are already flowing, driven by relentless orders for its specialized chips. The company's market value has soared, but its balance sheet shows billions in actual sales, not just projections. These numbers are grounded in widespread, practical deployment, setting a benchmark for what real AI-driven value looks like before speculation takes hold. Private AI companies now trade at revenue multiples that would have seemed unthinkable even during the height of the dot-com era. Anthropic, for example, reached a $183 billion valuation by late 2025, despite reporting just over $5 billion in annualized revenue. That is nearly 37 times its current sales. For comparison, established giants like Microsoft and Google typically trade at less than 15 times revenue. These numbers are not outliers. In recent secondary transactions, investors have paid 20 to 50 times revenue for leading AI startups, banking on the idea that future growth will justify today's prices. The math behind these valuations depends on aggressive scenario modeling. Bullish projections assume Anthropic's revenue will quadruple in just 2 years. Margins will expand to 60% or more, and adoption will outpace even the fastest software-as-a-service markets of the last decade. If any of these assumptions falter, if enterprise spending slows, if competition drives down prices, or if customer churn rises, the implied value can drop by half almost overnight. Analysts and some insiders have questioned whether internal metrics, often shared only with select investors, reflect real-world usage or simply the most optimistic forecasts. While no evidence of outright metric inflation has surfaced, the lack of transparency itself becomes a risk. In this environment, belief in the future can do more to inflate numbers than any spreadsheet ever could. Margin debt. Margin debt in the United States reached $1.13 trillion by September 2025, climbing nearly 40% in just 5 months. This surge is more than a headline. It is a signal that investors, both retail and institutional, are borrowing at record levels to amplify their bets on the market's continued rise. Over the same period, the technology sector swelled to 44% of the total market weight of the S&P 500, far above historical norms. This means that a handful of companies driven by AI now dominate not only investor attention, but the very structure of major market indices. Mechanics. The mechanics behind these numbers matter. When investors use borrowed money to buy shares, small price drops can trigger margin calls, forcing them to sell into a falling market. In a highly concentrated environment, declines in the biggest names quickly ripple through index funds and ETFs. Passive investment vehicles now hold enormous stakes in the largest technology stocks, and they automatically rebalance as prices move. If a correction hits, these funds can be forced to sell large volumes of shares at once, amplifying volatility and draining liquidity when liquidity is needed most. Passive funds. Institutional actors, including brokers, index funds, and hedge funds, are deeply entwined in this structure. Their positions are interconnected across direct holdings, derivatives, and leverage. The concentration of ownership means that price moves in a few names can transmit quickly across markets that appear diversified on paper. Leverage. Exposure to leaders driven by AI is not just exposure to a sector. It is exposure to the machinery of leveraged finance. When leverage is high, small shocks can force rapid, forced selling. That selling feeds on itself, producing sharper declines and reducing the market's ability to absorb losses. Belief-driven valuations. The result is a system where belief-driven valuations are no longer just a psychological risk. They are embedded in the plumbing of the market itself, creating clear pressure points that can magnify even a modest downturn into a cascade. Understanding concentration and leverage is essential to assessing whether current AI investment patterns are safe or whether they make the market more fragile. Regulators and risk officers are watching the AI-driven market surge with a measured sense of concern. In April 2024, FINRA cautioned that intense enthusiasm around new technologies often coincides with spikes in margin debt and sector concentration, amplifying both gains and losses. Marcia Asquith, FINRA's chief legal officer, noted in May 2025 that concentrated bets on rapidly advancing technologies demand extra vigilance from investors and institutions alike. Across the Atlantic, the Bank of England's June 2025 Financial Stability Report highlighted how the dominance of large tech stocks, many linked to AI, raises the risk of sudden severe adjustments if sentiment turns. The report drew a direct line to past episodes, from the South Sea bubble to the dot-com bust, as reminders of how concentrated optimism can leave markets exposed. These signals do not declare a crisis, but they urge careful attention to leverage and to the growing weight of belief in today's valuations. A sudden 25% drop in the largest AI stocks would set off a chain reaction across the financial system. Margin calls would hit first, brokers demanding immediate repayment from investors who borrowed to buy at the peak. Forced selling would begin, as accounts unable to meet new requirements see their holdings liquidated automatically. This wave of selling would spill into index funds and exchange-traded funds, which now hold concentrated positions in the same companies. As these funds rebalance, they would offload billions of shares, further depressing prices. The feedback loop intensifies. Each new round of selling triggers more margin calls, pulling even cautious investors into the spiral. Liquidity dries up as buyers step back, and the market structure amplifies every move. Index reweighting then kicks in, shrinking the role of AI stocks in benchmarks and forcing passive funds to sell even more. What starts as a correction in a few companies ripples outward, touching portfolios and retirement accounts far beyond the technology sector. Capital floods into AI today faster than regulators or fundamentals can adapt. As AI investment outpaces real-world results, the line between innovation and speculation blurs. History shows markets rarely correct gently. The test now is whether we heed the warning signs or repeat them, just at machine speed.